Okay, so let's unpack this. We've got this week in review document. It covers June 3rd through the 9th, 2025.
That's right.
And our mission today, pretty straightforward. We're going to do a deep dive into this source. Pull out the most important nuggets about the economy, the markets from that week.
Exactly. Kind of cut through the noise.
Yeah, think of this as your shortcut, really, helping you get sharp on what actually moved the needle. So let's start with the economy. What did this review highlight? It mentions the ISM manufacturing data early in the week. 48.5. What's that telling us?
Well, anything under 50 on that index, it generally signals contraction, not just slow growth, but actually shrinking.
Okay, so 48.5 is pretty clear then.
Yeah, it's a fairly definite signal that U.S. manufacturing was likely contracting during that time. It's a bit of a yellow flag for that sector.
Right, a sector under some pressure. Okay, then Friday rolls around, the big one, the jobs report.
Always is.
Headline number, 139,000 jobs added. Looked. Okay. I mean, it seemed slightly above the 126,000 expected.
It did, on the surface, but, and this is really crucial, the source flags this up, the previous 2 months, they got revised down significantly by about 95,000 jobs in total.
Wow. Okay, so that changes things.
It really does, because when you factor that in, the actual underlying pace of job growth, it weakened. It wasn't quite as strong as that 139K number first made it look.
So you got to look past the headline, see the bigger trend, which was slowing down a bit. What about the unemployment rate?
That was more stable. It came in at 4.2%, right on the money with expectations. It's actually stayed in a pretty tight range, like 4% to 4.2% for the past year or so. So that part, relatively steady.
Okay. And looking forward, the document mentions some big data points coming up this week.
It does. Key inflation numbers. We've got CPI, that's the Consumer Price Index, and PPI, the Producer Price Index. Expectations are around 0.2% month over month for both, and maybe 2.5% year over year, give or take.
And these are important because
they're what the Fed watches like a hawk when they think about interest rates. Super critical. Plus, we also get the University of Michigan's consumer sentiment reading.
How people are feeling.
Exactly. Gives you a sense of the consumer mood.
And maybe because of this sort of mixed picture, maybe leaning a bit weaker with those revisions, market expectations for Fed rate cuts shifted.
They did nudge up a bit. The probability that markets are pricing in for the Fed to cut rates by 50 basis points or less, so 0.5% or less by the end of 2025, that rose from 68% to 76% during the week.
Okay, which leads us neatly into the market reactions. And this is where it gets, well, a little puzzling, right?
Definitely a bit of a head scratcher.
U.S. stocks, they had a decent week overall, but big gains on Friday, specifically after that jobs report.
Yeah, that's the weird part. Why rally so hard on a jobs report that, once you look at the revisions, actually showed some weakening?
Right.
Well, one theory is maybe investors just latched onto that headline beat, ignored the revisions, perhaps, saw it as, okay, economy strong enough, no deep recession.
And the rally in small caps on Friday might support that view, like less fear.
Could be. Small caps are often seen as more sensitive to domestic growth, so a rally there might suggest reduced recession fears.
But here's the counterpoint. If the market really thought the economy was stronger, wouldn't that mean the Fed wouldn't cut rates as much?
Exactly, which should, in theory, be bad for bonds. And bonds did sell off on Friday. Yields went up.
Okay, so wait. If investors saw the report as weak because of the revisions, suggesting the Fed would cut rates,
then you'd expect both stocks and bonds to rally, generally speaking. Lower rates are usually good for both asset classes.
But that didn't happen. Stocks rallied, bonds sold off.
Precisely. So it really raises the question, are stock investors and bond investors seeing this completely differently? Are they disagreeing on what that jobs report and the whole economic picture actually means for the Fed?
A real divergence there. Interesting. What about globally? Quick look.
Yeah, quickly. World markets were moving too. Developed markets outside the U.S., they slightly underperformed the U.S., but actually hit a record high midweek.
Okay.
And emerging markets had a pretty strong week, up about 2.5%.
All right. Let's circle back to bonds and rates specifically then.
Yeah.
Definitely sounds like there was some volatility.
Oh, absolutely. Overall, bonds sold off just a tiny bit for the whole week, but inside the week, big moves. Like Wednesday, yields fell quite a bit. The 10-year Treasury yield dropped 9.5 basis points. Remember, a basis point is just 0.01%. So that was a decent rally in bond prices.
Okay, yields down Wednesday. But then Friday?
Friday reversed it. that big stock rally, mirrored by a big bond sell-off. Yields shot up 11.6 basis points just on Friday.
Wow. So down sharply, then up even more sharply.
You got it. So all that churning, the net effect for the whole week on the 10-year Treasury yield, it only rose about 2 basis points, ended the week at 4.48%. Lots of noise, not much net change week over week.
So let's try and tie this together for you, the listener. This review from June 3rd to 9th, it shows a real mixed bag, doesn't it?
It really does.
You've got some data, like that ISM manufacturing, the jobs report revisions, pointing to maybe some underlying softness, some slowing.
Clear signs of weakness in certain areas.
But then you have the market reaction, especially stocks on Friday, rallying strongly, while the bond market did the opposite on the exact same news. Seems contradictory.
It highlights just how complex things are right now. The signals the economy and the markets are sending out, they're not all pointing in the same direction. It can be confusing.
Definitely. So here's maybe a final thought for you to mull over. Given these conflicting signals, manufacturing weakness versus those job numbers that look strong until you saw the revisions, and then stocks going up while bonds went down on that same news, what does all this really tell you about the true underlying health and maybe the future direction of the economy right now? Something to think about.